Most sellers believe the hardest part of selling a home is simply getting an offer. They think once an offer is accepted, the deal is basically done. But the truth is, the sale does not succeed or fail because of the house. It succeeds or fails because of the buyer's financing. In fact, buyer's financing is the number one reason escrows gets delayed, negotiated, or completely fall apart. And here's what's scary. Two buyers can offer you the exact same price, and one will close smoothly while the other could collapse halfway through escrow. Most sellers don't understand why. They don't know what to look for, and they don't realize they might be choosing the riskiest deal without even knowing it. So today, I'm going to walk you through what sellers don't understand about buyer financing, why it matters more than you think, and how to protect yourself so you accept the offer that actually closes. Hi, my name is Rima Rafe with the XP Realty and team leader for the Rafe Group. And this is what every seller needs to know before accepting an offer. Now let's slow this down, because the first thing you need to understand is this. Buyer financing is not one step. It's not just one phone call, and it's not just a letter. Buyer financing is an entire process. And the reason sellers get blindsided is because you don't see most of it happening. From your side, escrow can feel quiet. You accept an offer, then suddenly there's paperwork. And then there's inspections, lender needs something, the buyer wants extensions, and it feels like everything is unpredictable. But financing is actually very predictable once you understand what's happening behind the scenes. So let's pull the curtain back. The first misconception is this. A pre-approval does not mean the buyer is fully approved. A pre-approval is just the beginning. It's a lender saying, based on what we see right now, you probably qualify. But probably is not a guarantee, because most pre-approvals are based on information the buyer provides, not information that has been fully verified. Things can change. Jobs can change. Debt can increase and credit scores can drop, and documents can be missing, and the underwriting can raise new questions. This is why sellers need to understand financing is not just a checkbox. Financing is a process. Now let's talk about underwriting, because underwriting is where loans become real. Underwriting is the lender's deep investigation. And this is where the lender stop trusting and start verifying. They verify everything from income to employment to bank statements. They verify large deposits, credit history, they verify debts, and they verify everything. And underwriting is where most problems appear. This is why sellers should never assume the deal is solid just because the buyer has a nice letter. Because the truth is, underwriting can still say, we need more documentation, or we need more money as reserves, or we need more clarification on some of the paperwork. And sometimes they cannot approve this loan because something came up. Now let's talk about loan types, because not all loans behave the same way. Sellers often assume a loan is a loan, but conventional loan, FHA loan, VA loan, and jumbo loans, they all work differently. And sellers who understand this have a huge advantage. Let's start with conventional loans. Conventional loans are the most common. They're usually more flexible and they tend to close smoother, especially when the buyers has strong credit and reserves. Conventional loans also tend to have fewer property condition requirements. That means minor wear and tear usually isn't a big issue. Now, FHA loans are great programs, but they come with stricter rules. The home must meet minimum property standards. That means things like peeling paint, missing handrails, roof concerns. Electrical issues can become lender-required repairs, not because the buyer is picky, because the loan requires it. Now, VA loans, on the other hand, are for veterans, and they're excellent loans. But they also have condition and appraisal standards. A VA buyer may also request seller's credit more often, not because they're weak, because the structure of the loan allows it. Now, jumbo loans. Jumbo loans are common in California, especially for higher priced homes. These loans have stricter underwriting, more documentation, and more reserve requirements. Even wealthy buyers can face delays because jumbo underwriting is intense. Now let's talk about down payments because sellers often misunderstand what they really signal. Sellers love big down payments. They assume that big down payments equals safe deal. And sometimes that is true, but not always. A buyer could be putting 30% down but still have complicated income or self-employed or assets tied up or underwriting risk. Meanwhile, a buyer putting 10% down with clean W-2 income, strong reserves, and great documentation may close faster. This is why sellers need to look beyond the down payment number and evaluate the full financing picture. Now let's talk about contingencies because financing is tied directly to them. Most finance offers include a loan contingency. That contingency protects the buyer if financing fails. From the seller's perspective, until that contingency is removed, the deal is not fully locked. This is why sellers should not emotionally move too fast. This is why timing matters. Now let's talk about appraisals because appraisals are not just formalities. When a buyer is financing the home, the lender orders an appraisal. If the appraisal comes in low, the buyer may need more cash. The seller may need to renegotiate, or the deal may collapse. Sellers often feel blindsided, but this is normal in finance transactions. This is why buyer reserves matter. Now, another factor sellers rarely think about is rate locks. Interest rate can change during escrow. If the buyer does not lock the rate from the beginning, their payment could rise. And if their payment rises, their approval could tighten, and financing is not frozen. It moves with the market. Now let's talk about the lender quality because lender quality can make or break your sale. Two buyers can look identical, but one lender can close smoothly while another creates chaos. A strong lender communicates. A weak lender disappears. A strong lender solves problems early. A weak lender creates surprises late. This is why sellers should care who the lender is, not just the buyer. Now, here's what I can share with you about the best offer. The best offer is not always the highest offer. The best offer is the one the most likely to close with the least drama, the least negotiation, and the least risk. Financing strength is leverage. So if you are selling, don't just ask what's the price, ask how strong is the buyer's financing? Because the deal that closes is the deal that matters. If you want help evaluating offers and choosing the right buyer, I'd love to help. And if you feel this video is valuable, please press the like button, share and subscribe, and we'll see you on the next video.